Welcome to Everyday Money Matters, where we explore practical tips on saving and making money in your daily life. Get ready to embark on a journey towards financial empowerment and smart choices. Subscribe now and let's make every day count for your wallet. In today's video, we will discuss financial trends to watch for in 2024. Now let's get to it. In an effort to temper runaway inflation, the Federal Reserve began a policy of raising the federal funds rate in March 2022. The federal funds rate is the rate at which lenders borrow money to finance banking and lending operations. It sets a benchmark that most consumer lending and savings rates are based on. The higher the federal funds rate, the higher mortgage and personal loan rates are likely to be. At the time rate hikes began, the rate had sat at 0.08%. By August 2023, the rate had reached 5.3%, a 562.5% increase. This rate increase resulted in similar increases to consumer lending rates, such as those for mortgages, auto loans and credit cards. Increases to consumer lending rates added substantial costs for people who borrowed money to make purchases at a time when inflation was still driving up the price of goods and services, compounding expenses for American households. But the Fed made the last of those rate hikes in July 2023, and the federal funds rate has remained steady since. Federal Reserve Chair Jerome Powell has been insistent that the rate would not go down until the target of 2% inflation was reached. Nonetheless, financial experts and even some Fed officials themselves have predicted that the Fed will begin a series of rate drops in 2024, despite the inflation rate remaining at 3.9% at the time of publication. Most predictions peg the first rate drop to happen at the March 19, 20 meeting of the Federal Open Market Committee, FOMC. The general consensus prediction is that the Fed will drop the rate by 150 points, 1.5%, in 2024, reaching a rate of 3.8% by the end of the year. Powell's use of the federal funds rate as a tool to reduce inflation has had its intended effect, to some degree. After peaking at 9.1% in mid-2022, inflation began to cool in mid-2023, a little over a year after the rate hikes began, coming in at an estimated 3.4% by the end of the year. Experts predict that this trend will continue in 2024. The combined average predicted inflation rate for 2024 from 9 of the country's largest financial firms is 2.5%, based on information collected by Reuters. Student loans have made headlines over the last several years due, in part, to the massive amount of student debt Americans are holding, reaching $1.6 trillion in 2023. But they've also been a fixture in the news because of the back-and-forth fighting between different factions in the federal government over forgiving those loans. Thousands of people got significant relief near the start of the year when it was announced in January that the government would fast-track its forgiveness program. The Biden administration revealed that it would forgive the debts in February of anyone who borrowed $12,000 or less and have been paying towards that debt for 10 years or more. This plan also includes a graduated forgiveness rollout for people who borrowed more. Americans will also head to the polls in November 2024 to cast their vote for president. While there is relatively little difference between market growth in election years compared to non-election years when looking at year-on-year data, closer inspection reveals a more dynamic pattern. The first half of presidential election years tend to be bearish. Historical data for the Dow Jones Industrial Average shows that the Dow's year-to-date performance is 0.7%, on average, at the midpoint of election years. This is a full 5 percentage points below its average gain of 4.3% during non-election years. However, things tend to heat up in the second half of election years. In non-election years, the Dow's average second-half returns average 3%. But in election years, the Dow averages 8.6% in returns for the second half of the year. Many of the expected financial trends for 2024 would be good news for most Americans. However, some of that optimism may be tempered by a dark financial cloud looming over the country: record levels of household debt. Americans entered 2024 holding $17.3 trillion in household debt, which includes mortgages, credit cards, auto loans, student loans and other types of loans. This figure is the highest in the history of the country, exacerbated by soaring interest rates over the last 2 years. While interest rates are expected to go down over the course of 2024, even the predicted lower rates would still be high in comparison to previous years. This means paying those debts down will still be a tall task for many Americans. Millions at increased risk of falling behind on payments or defaulting could complicate an otherwise optimistic financial outlook for 2024. If you found this video helpful, give it a thumbs up, and share it with anyone who might benefit, and don't forget to subscribe. Thanks for watching. See you in the next video.